So in today's video, I'm going to go over uh, the mistake that most retail type traders make. They assume that they can find some kind of strategy that will always, produce gains. You never have a drawdown. They tend to jump from one newsletter service to the other, whoever happens to be hot at the moment. And of course, what tends to happen is the reason a newsletter is hot is because they've been correct for a extended period of time to where enough people finally take notice, and instead of thinking logically and understanding that after a long run, usually what happens is the strategy that they are using will quit working or will suffer a drawdown. So what happens to most retail traders is they jump on board at the end of a trend, whether it be a trend in an asset market, gold, stocks, oil, whatever, or a trend of a newsletter writer or analyst that has been on a winning streak for an extended period of time. And the way the markets work, that is the wrong thing to do. But of course, most traders are unable to control emotions. Their emotions prevent them from thinking logically. If they could, they would rationalize that if a trend has been in place for a long time, then it's probably due to reverse. So you don't want to jump on the trend after it's been in place for 7 months. Gold recently was a perfect example. At the top a few weeks ago, I saw a lot of people extrapolating that 7-month move, forward into the future indefinitely. And of course, that's the point at which gold reversed and moved back down. And I'll switch this over to the gold chart. So, at this top, a lot of analysts, a lot of newsletter writers were, just assuming that this trend that had been in place since August was just going to continue. And, so they're, extremely bullish, pumping the long side. And this is the point at which I was warning people that 7 months into a trend is too late to jump on board. It's too late to start following the analyst that's been bullish all the way up. This is the point at which you've got to start looking in the other direction. You got to take the contrarian view. This is the point at which I recommended people start taking profits or really tightening up their stops and their metal positions. And then, just as I expected, we have started an intermediate decline. Again, I saw a lot of people during this bounce, again, assuming that I was wrong and that, this was just a correction. And it is in the overall big scheme. This is just a correction. But the intermediate degree correction is unlikely to be over at this point. They almost always unfold as at least an ABC pattern. So you'll get a first leg down, and then you get some kind of bounce that gets everybody bullish prematurely, and that is exactly what happened right here. I saw a lot of people wanting to jump on board quickly again, thinking they had caught the bottom of the correction and that gold was, on its way back up to 14 and 1500, and they needed to buy quickly so they wouldn't get left behind. And generally, if you're still feeling that kind of pressure to buy, the fear of missing the move, then that generally means that the intermediate decline is not over yet. And I don't think it is. I think today this big bearish engulfing candle that's forming in gold today, and I'll show you the silver chart as well. Okay, here's silver. You can see, big red candle back below the 200-day moving average. It's not going to take much more downside to break below this, which will confirm that this was, a B wave bounce, and we still have further to go on the downside. Again, this just people are behaving just like they always do. There is almost always a bounce here during this, in the middle of an intermediate decline. People that have finally become convinced that the trend is up and is going to stay up for the foreseeable future. They want to jump on board too quickly, and then they get caught in this next leg down. And usually, what happens is they get stopped out right about where the final intermediate bottom is, and then they're shell shocked. Then their brains have become cemented into the bearish mindset, and they can't buy. Especially if they sell down here and they take another loss, then they're kind of shell shocked, and they're not able to pull the trigger again for the next intermediate rally higher. Moving on to the stock market, and this is a perfect example. I've gone over this several times in previous videos. We just entered long positions too early during this intermediate decline. I was not expecting a fifth daily cycle. We did manage to avoid this final bloodbath phase, but so many people, again, just not able to control emotions, not able to think logically when the market's going down like this. They can't envision a future where the market turns and goes in the other direction. We got caught in this fifth daily cycle. We took a big drawdown. People can't envision a scenario where they can recover from this mistimed trade. And so, they give up and they sell, at the bottom, and then they go looking for, someone that, can supply them with a strategy that works 100% of the time, so they never have to take a drawdown. And of course, there is no such thing. Every strategy gets broken from time to time. There has never been a strategy in the history of the world, or an analyst in the history of the world, that doesn't have a bad trade from time to time. But if this strategy is robust, you can recover from it. And at this point where we had to sell and take that loss, we were down a good amount for the year. But I don't let my emotions control me. I understand that corrections create opportunities, and that we would get an opportunity to recover from our mistake and continue to build the portfolio. And that's exactly what we've done. I switched over from a stock market trade at this point where we stopped out, and moved over to the energy sector. Let me switch over to oil. Because energy is a lot more volatile than the stock market, I understood what was happening. We were moving down into a 4-year cycle low in the stock market and a 3-year cycle low in the commodity complex. So the prospects for recovering from that poor trade were much better in oil, which is a lot more volatile than stocks. And so we entered our position in oil right in here, and we're still holding it, and we have now completely recovered that poorly timed trade. And in fact, the stock portfolio as of right now has gone to plus 260% over the last 3 years. So the people that threw in the towel, gave up, went looking for someone else, they made the same mistake here that the gold traders made back in 2016. They let their emotions make their decisions for them, and instead of sticking with the proven strategy, understanding that from time to time bad trades will happen, to everyone. Every strategy is going to break from time to time. But if the strategy is robust, then you will eventually you'll recover. And as of right now, the SMT portfolio is back in the hunt at plus 45%, and I believe I'm now in the top 5 or 6 in the challenge. Last year I was 5th, so if you combine both years, I'm at this point probably the top performer over the last 2 years, and certainly over the last 3 years. The metal portfolio is up considerably more than 400%. The stock portfolio is up 260% over the last 3 years. So over time, we are consistently growing the portfolio, even though from time to time we make a bad trade. There are just events that aren't foreseeable with my strategy. A 5th daily cycle in the stock market was just something that, it's like a Six Sigma event. It just never happens, so there's no way to plan for it. A 4-year cycle low that occurs, more than a year ahead of schedule, again, is just an outlier event that there's really no way to plan for. But that doesn't mean that you can't recover from that mistake. And as I've shown, we have recovered, and all the people that threw in the towel and gave up and went looking for something else, they did themselves a terrible disservice, because now we have recovered all of those losses and considerably higher than we were in the portfolio than even at this top back here. The portfolio at this point was up about a little over 200%. Now we're up 260% at this point down here. So, just emotions wreck people's portfolios. A consistent, robust strategy, even though they don't work, nothing works 100% of the time. A consistent, robust strategy, if adhered to religiously over time, will produce gains. And over the 25 years that I've been doing this, I have never yet found any strategy that can produce better long-term gains than one using cycles and sentiment as my base trading tools.